Welcome to Gold Bank Insider.
It's good to be here.
We're here to break down some of the practical precious metals and mining updates, specifically for our UK audience. The focus is really on clarity, not hype.
Exactly. I think our mandate today is pretty clear. We need to strip away some of the noise and just look at the mechanics of what's happening in the market.
Right. And today, our focal point is Barrick Gold. Now, usually when you open the financial pages or scroll through your feed, the headlines are, well, they're screaming at you. They want you to believe every single movement is a revolution or a crash. But that's rarely how the industry actually works.
Not at all.
Today, we're looking at a standard but decidedly noteworthy corporate restructuring, specifically a planned IPO of Barrick's North American gold asset.
That's the main event, yes. And paired with that is the second component, which is the appointment of a new CEO, Mark Hill, who's going to steer this whole phase.
So we've got a restructuring and a new captain at the helm. It sounds big, but, we need to keep our feet on the ground here.
Precisely. And I think it's crucial to frame this correctly right from the start. This isn't about, seismic market shifts.
No.
We're not talking about the ground moving beneath our feet or the industry being reinvented overnight. This is just a look at how a major player is reorganizing its portfolio.
Okay.
And we need to understand what those mechanics actually mean for investors, particularly those listening from the UK, who might be holding these shares without, fully realizing the structural changes that are coming.
Right. It's about connecting the dots. We've got a corporate announcement, we've got the actual balance sheet, and then we have the risks that are sort of sitting there in the background.
That's the goal.
Yeah.
We need to see how all three of those things interact with each other.
Okay, so let's unpack this. We'll start with the strategic shift. The headline is that Barrick is preparing for an initial public offering of its North American assets. When you hear IPO, you usually think of a new tech startup ringing the bell. But this is an established giant slicing off a piece of itself. What does that actually, look like in practice?
Well, first, we need to clarify the timeline and the structure, because the devil is always in the details with these things. This isn't happening tomorrow.
Right.
The expected timing for this IPO is late 2026. So we're looking at a pretty long runway here.
Late 2026? That seems like a lifetime away in market terms. Why announce it so far out?
It's all about signaling. You just don't spring a restructuring of this magnitude on the market over a weekend. You have to prepare the books, prepare management, and frankly, you have to prepare the investors.
It gives them a target date to work toward.
Exactly. It's a slow burn. And the second thing to understand is the split itself. Barrick isn't selling the whole house here. They aren't packing up and leaving the continent.
So they're just floating a piece of it.
Correct. They plan to offer around 10% to 15% to the public.
Wait, only 10 to 15%, so they're retaining a massive controlling stake.
Yes, the vast majority of the asset remains under their control. They're essentially just floating a minority slice to the market.
If they're keeping, 85 or 90% of it, why bother with the IPO at all? What's the logic there?
It's about unlocking value, to use the corporate phrasing. The theory is that the market is undervaluing these specific assets because they're buried inside this massive global conglomerate.
Right.
By listing them separately, even just a small slice, you force the market to give them a specific price tag. And Barrick believes that price tag is going to be higher than what's currently implied in their share price.
They want the market to do the math for them, essentially.
In a way.
And speaking of math, there's a number floating around for the valuation. Analysts have estimated a valuation of roughly $42 billion for these assets.
That's the figure being discussed, yes. $42 billion.
That's a staggering number for just a subsection of a company. There are entire FTSE 100 companies worth less than that. We need to clarify what exactly is included to justify that number. Which assets are we talking about here?
It's a robust portfolio. When they say North American assets, they are primarily talking about Nevada gold mines. This is a massive complex.
The crown jewel.
It's the crown jewel of gold production in the United States, yes. But the portfolio isn't just Nevada. It also includes the Pueblo Viejo mine in the Dominican Republic.
So geographically, North American is stretching a bit. The Dominican Republic is in the mix.
In terms of corporate grouping, yes. It fits into that regional bucket. And it also includes the Fourmile project, also in Nevada.
And Fourmile is the exploration piece, right? The future potential.
Exactly. So look at that mix. You've got Nevada gold mines, that's your steady, massive production engines. You've got Pueblo Viejo, another production powerhouse. And then you have Fourmile, which represents the future growth. That whole package is what analysts are valuing at around $42 billion.
It does make the valuation figure make a bit more sense. You're bundling some premier locations, and I suppose the logic is that investors will pay a premium for assets in safe jurisdictions. Nevada is politically stable compared to, say, parts of West Africa.
That is the entire thesis. It is the safety premium. Investors might be willing to pay a higher multiple for earnings coming out of Nevada than earnings coming out of a more volatile region. By separating them, Barrick hopes to capture that premium.
Okay, that covers the structural change. Let's pivot to the leadership.
Yeah.
You can't execute a plan like this without a general. We mentioned Mark Hill.
Yes, Mark Hill.
He was the interim head, and now he's officially named chief executive and president.
And this is a really crucial piece of the puzzle. Analyze the timing. They're aiming for this IPO in late 2026. Naming the permanent CEO right now provides stability.
It stops the guessing game.
Exactly. You can't go into a major restructuring in a public listing process with an interim tag on your leader. It makes investors nervous.
Yeah, of course.
They wonder if the strategy will change if a new person comes in. Removing that interim label signals to the market that the strategy is set, the leadership is settled, and the focus now is purely on execution.
It tells the market, this is the guy and this is the plan.
Precisely. It removes a variable. When you're asking investors to value a company at $42 billion, you don't want variables. You want certainty.
Okay, so the team is in place. The target is set for late 2026. Now let's look at the financial picture. Barrick just put up their Q4 earnings, and if you just look at the top line, the headline numbers, it looks like good news. They beat expectations.
They did. If you run through the data points, the numbers are strong. Adjusted earnings came in at $1.04 per share.
And revenue.
Revenue hit $6 billion. And to give that some context, that's up 65% year on year.
Wow. 65% up. That's a massive jump. If I saw a 65% revenue jump in a tech stock, I'd be ecstatic.
It is impressive. But we have to pause and ask, why the jump? Is it because they became 65% more efficient or dug 65% more holes in the ground?
I'm guessing the answer to that is no.
No, it's largely driven by high gold prices. The underlying commodity price is doing all the heavy lifting here. When the price of what you sell goes up, your revenue goes up, assuming you can get it out of the ground.
So the wind was at their backs. The market conditions were favorable. But for a shareholder, does it really matter why the revenue is up as long as it is up? How does that translate to their return?
Well, there's a very clear cash return angle here. In Q4 alone, they did $500 million in share repurchases.
That's a substantial buyback, $500 million.
And they issued a 42-cent dividend.
So for an investor, this is the payoff mechanism, right? High gold prices converting into direct returns via buybacks and dividends.
That is the theory. And in this last quarter, that was the practice. It shows the cash generation engine is working.
But, and there's always a but, in this sector, the market reaction wasn't a unanimous celebration.
No, it was not. Far from it.
Despite the earnings beat, the reaction was really split. U.S. trading was positive pre-market, but then the Toronto-listed shares fell 6.7%. That's a real discrepancy. Why the drop in Toronto? Why did the domestic market punish them?
This is where we get into the cost of doing business. Investors, particularly those looking closely at the details, and the Toronto investors know this sector better than anyone, they looked past the revenue jump and stared straight at the expenses and the risks.
They looked at the debit column.
They did. And specifically, the drop seems to be linked to the Mali settlement.
Right, the situation in Mali. We need to talk about this because it isn't just a footnote in the report.
It certainly isn't. This is a major drag on the books. The total cost reached $823 million regarding a dispute with the Mali government.
$823 million. That's nearly $1 billion.
It is.
That eats a lot of profit. I mean, we just celebrated $6 billion in revenue, but then you have to hand almost $1 billion of that over to resolve a dispute.
It changes the math entirely. And it's not just the money. It's what that money represents. It represents the friction of operating in difficult jurisdictions. This is what we call sovereign risk or political risk.
It feels like a retrospective tax, almost.
In many ways, it functions like that. When you operate a mine, you're essentially a guest in that country. And if the government decides the terms need to change, or if there's a dispute over taxes, the miner often has very little leverage.
You can't just pick up the mine and move it somewhere else.
You are a sitting duck. Exactly. So Barrick had to settle. And paying $823 million is a painful way to clear the decks. But it wasn't just the financial settlement. There were operational challenges as well.
You're referring to the safety issues.
Yes. There were mentions of mine-related fatalities.
Which is tragic, obviously, first and foremost.
It's a human tragedy, absolutely. But we have to look at it through the investment lens as well. Fatalities signal operational instability. They often lead to shutdowns, investigations, stricter oversight. It suggests that operations just aren't running as smoothly as the spreadsheet might suggest.
It speaks to operational stability. If you're having safety issues, you're likely having efficiency issues, too.
Correct. So if we analyze this, it illustrates perfectly that a miner is not a simple proxy for gold prices. You can't just buy a mining stock and assume it's going to track the spot price of gold perfectly.
Because political outcomes and operational safety can just destroy those margins.
Exactly. You can have revenue up 65% because gold is expensive. But if you have to pay out $823 million to a government, that margin gets eroded very, very quickly. The quality of the earnings is different.
It's a stark reminder. So we've got the current snapshot, strong revenue driven by gold prices, but these heavy costs driven by geopolitical reality. Now, what about looking ahead? What's Barrick promising for the future? Specifically, looking at that 2026 timeframe for the IPO.
Well, they've issued guidance figures. For gold production, they're forecasting between 2.9 and 3.25 million ounces.
Okay, so that's the volume. Gives us a sense of scale. But, volume is vanity, profit is sanity. What about the cost to get it out of the ground?
That is the critical number. The AISC, or all-in sustaining costs, they're projecting that to be between $760 and $1,950 per ounce.
$1,760 to $1,950. I want to pause on that acronym, AISC. We hear it all the time. All-in sustaining costs. For the listener who doesn't spend their day with a mining glossary, why does that number matter so much more than just, operating costs?
It's a vital distinction. Cash costs just tell you what it costs to dig the ore and process it. But a mine is a depleting asset. Every ounce you take out is gone forever. You constantly have to repair equipment, build new tunnels, and do development work just to maintain or sustain production.
So AISC includes the cost of keeping the lights on and the mine alive. It's the true cost.
Exactly. It's the true cost of staying in business. If you sell gold for $2,000 and your cash cost is $1,000, you think you made a $1,000 profit. But if your AISC, your sustaining cost, is $1,800, you actually only made $200.
That is a huge difference.
It is. And that's why these numbers, $762 to $1,950, matter so much. It sets the floor for profitability. Investors need to be watching these cost projections against the spot price of gold.
Right. So if gold is trading at, say, $2,500, that margin looks pretty healthy. You're making $500 or $600 an ounce. But if gold drops, or if those costs rise,
that margin just evaporates.
If costs creep up toward that $2,000 mark, the margins get compressed regardless of how much gold they dig up.
Precisely. If your AISC hits $1,950, you need a very healthy gold price just to break even on a sustaining basis. You stop generating the kind of free cash flow that funds those dividends and buybacks we were talking about earlier.
So the margin for error gets tighter as costs rise, and inflation is real in this sector. Fuel is expensive, labor is expensive, steel.
It absolutely is, and that's why that guidance is the anchor for any valuation model leading into 2026. The market will be watching to see if they can actually hit those cost targets, or if inflation keeps pushing them higher.
Okay, let's pivot the conversation now. Let's bring it home to our listener in London or anywhere else in the UK. Why does a North American IPO actually matter here? Why should a UK investor care about how Barrick restructures its Nevada assets? We're thousands of miles away.
It's a fair question. But the mining world is global, and London is a hub for this kind of capital. I think there are 4 key takeaways specifically for the UK audience.
Okay, let's run through them. What's number 1?
Number 1 is valuation clarity.
How so?
An IPO forces the market to put a specific price tag on a specific slice of the business. Right now, Barrick is a giant conglomerate of assets. It's a black box to some degree.
It's basket. You buy the basket and you get everything, the good, the bad, and the ugly.
It's a basket, yes.
Yeah.
But if the North American assets get a high valuation as a standalone entity, if the market agrees with that $42 billion estimate, it creates a benchmark. It tells you exactly what the good part is worth.
It sets a price for the individual parts.
Exactly. And that changes how investors value the remaining group. If the North American slice is worth X, then the rest of the company implies a value of Y. For a UK investor holding the stock, this helps you understand if the company is currently undervalued.
Okay, that makes sense. That's valuation. What's the second takeaway?
The second is portfolio structure. And this is very practical for UK investors.
Because many UK investors don't hold the stock directly. They hold it in a fund.
Precisely. Many UK investors hold miners via ETFs, global funds, or mainstream investment accounts. You might have a global natural resources fund or a gold and general fund in your ISA or your pension.
And they might not even know they own Barrick specifically.
Right. But Barrick is so big, it's in almost all of them. And corporate actions like this change the composition of those funds. When you spin off a massive asset, the market begins to separate the asset, the North American mines, from the group Barrick as a whole.
So the fund you're holding might have to adjust its weighting.
It might. Or the risk profile of what's left in the parent company changes. If the safe North American assets are spun out, the remaining Barrick entity becomes much more weighted toward those riskier jurisdictions we were just discussing.
That's a crucial point. If you strip out the safe stuff, what's left is inherently the riskier stuff.
Exactly. The underlying exposure you have changes. It's important to know what you actually own inside that fund wrapper.
That makes sense. What's the third point?
The third point is the reality of risk. And this brings us right back to that Toronto share drop.
The 6.7% fall.
Yes. This serves as a potent reminder to UK investors. We often get caught up in the gold trade. We think gold is up, so miners should be up.
It feels linear, doesn't it? Gold goes to $2,600, my mining stock should go up.
But it's just not that linear. It never has been.
No. High gold prices support the results, absolutely. But costs like that $823 million Mali settlement and country risk can easily outweigh the good headlines.
You can lose on the swings what you gained on the roundabout.
Exactly. If you're sitting in London looking at a global miner, you have to account for the fact that they operate in the real world with real political friction. That risk is tangible. You're not buying a gold bar in a vault in London. You're buying a complex industrial operation in a difficult part of the world. And the fourth takeaway.
The fourth is cash returns.
The dividends and the buybacks. UK investors love their dividends.
They do. The UK market is very income-focused. We mentioned the buybacks and the 42-cent dividend. Those are the direct link between global gold prices and an investor's bank account.
That's the money in your pocket.
It is. But the focus must remain on whether costs stay controlled enough to maintain those payouts.
It all comes back to the margin again.
It does. You can only pay dividends from profit. If the costs of production, that AISC number, or the cost of settlements eat up all the revenue, the dividend is at risk, no matter how high the gold price is.
So you can't just look at the yield today, you have to look at the sustainability of that yield.
Correct. And that's why the cost guidance for 2026 is just as important as the production guidance.
So to recap the main threads here, because there are a lot of moving parts, we have a major corporate move coming in late 2026 with the IPO. We have Mark Hill at the helm, so leadership stability is there. And the financials look strong right now, but that's driven by gold prices, while the risks, Mali, rising costs, safety, are very real and tangible.
That's the summary. It's a story of potential value unlocking, but it's tempered by operational and geopolitical reality.
So as we wrap up, what's the final thought? What should the listener be watching? If I have this stock in my portfolio, or I'm thinking about it, what are the signposts I should be looking for?
I would offer this closing perspective. If you hold gold miners, you have two distinct things to watch from here. First is the execution of this IPO strategy and the leadership transition. Can Mark Hill steer the ship to late 2026 smoothly?
Execution is everything. Plans are great, but actually doing it is hard.
It is. Corporate restructurings are messy. They can distract management, so watch for that. And second, watch whether the cost and risk pressures like those we saw in Mali remain contained, or if they continue to eat into the profits being generated by these high gold prices.
That's the tug of war.
It is. Revenue versus risk. That is the battle to watch. Can they keep the costs down and the politicians happy long enough to get the gold out of the ground and the cash to the shareholders?
Well, on that note, we will wrap it up there. Thank you for listening to Goldbank Insider. We hope this brought some clarity to the headlines.
Indeed. Keep watching the margins.
Goodbye for now.